It's like a disease that happens over and over again. There's a process. Everything that happens has a cause. And by understanding that process and cause, you know the red flags. And with those red flags, you know how to calculate whether people can pay their debts back and how the dynamic's going to work. When there's a certain rate of debt growth that is unsustainable and that there's going to be a problem paying it back, you could see that you have a problem. When you start to have a debt problem and you're close to zero interest rates, that means that the central bank, the Federal Reserve's ability to deal with that won't work. You'll hit zero. And then you enter a new world. Okay, the last time that happened was 1928 to 1929, 30, 31. That's what happened. What happened in 2007 and 9 was the exact same thing. A debt crisis, too much debt, and you hit zero interest rates and out of luck. And then what happens, there's a classic way of dealing with that, is that the central bank has got to print money and go buy financial assets. And so that's what all the entities did. And so by being able to watch it day by day as to how they went about doing that, allowed us to navigate the crisis so that we could see the rates of deterioration and then the actions taken to end that in much the same way as the Federal Reserve ended it in 1932, 1933, for the same reasons. Now that printing of money causes financial assets to go up in price, puts money into the economy, and produces the type of reaction that we've now seen in terms of that economy and those markets. Then we're at the stage of the cycle where we are now. And what happens, classically, is that those financial purchases help those who have financial assets more than they help those who don't. It causes a greater wealth gap. And very classically, that causes populism. And then you move into a situation that's very similar. So being able to see mechanically how that dynamic worked allowed us to navigate it well. The early part of the debt cycle is the great part of the debt cycle because the borrowing of money is being put into assets that are going to be able to pay back that debt and grow, and asset prices go up. Then you enter the bubble stage when everybody is extrapolating that because it happened in the past. Because those assets went up, they're going to continue to go up and they're going to continue to rise, and it pays to borrow money to do it, but they're not able to actually pay off their cash flow. The top of the cycle usually happens when the bubble exists and also the Federal Reserve or the central bank begins to tighten money to slow that bubble at the high part of the cycle. So as we take a look at that, we are approaching more the top of that cycle. I don't think we're there yet. I think we're in the 7th inning. When you have that tightening and then you have the turn down, I'll call the depression phase, that depression phase happens because you hit zero interest rates and because they're less effective in monetary policy. That's why 2008 was like it was in much the way 1930 was.
Thanks for watching. Don't forget to like and subscribe.